Welcome to the 18th episode of Nova Bourse. Today, we are kicking off our third season by tackling one of the most debated subjects in finance, the philosophy of technical analysis. We are going to explore whether the market truly has a memory, why charts sometimes act as self-fulfilling prophecies, and why they fail at other times, and the age-old tension between price action and fundamental value. Whether you're a total beginner or looking to sharpen your edge, understanding the why behind the how is critical. Let's pull back the curtain on the mechanics of the market. Consider the story of Paul Tudor Jones in 1987. He famously predicted the Black Monday crash by using chart patterns and deep structural analysis. His fund returned 125.9% that year, netting him roughly $100 million. Jones noted that the setup looked remarkably similar to 1929 and argued that the derivative structure of the time made the potential downside literally unlimited. Was this pure genius, or just a stroke of luck? Or, perhaps, is it proof that markets have a tendency to repeat their own history? That is the central mystery we are investigating today. On the other side of the fence, we have Burton Malkiel's famous claim from his book, A Random Walk Down Wall Street. He suggested that a blindfolded monkey throwing darts at a financial page could select a portfolio that performs just as well as one managed by the experts. His core argument is the efficient market hypothesis. If past prices actually contained useful information about the future, every rational investor would instantly exploit that data until the edge disappeared. It remains the single greatest intellectual challenge that anyone using technical analysis has ever faced. So, what is technical analysis? Really? Simply put, it is the study of price action, volume, and market structure to identify patterns that might indicate where the market is headed next. It operates on the core assumption that all known information is already baked into the current price. While fundamental analysis asks what a company is actually worth, technical analysis asks what the crowd believes it is worth. The key distinction here is that fundamental analysts are buying value, while technical analysts are buying into the perception of that value. Technical analysis rests on three philosophical pillars. First is market memory. The idea that past prices influence future behavior because participants vividly remember where they bought, sold, or missed out on a trade. Second is crowd psychology. We have to remember that markets are not calculators. They are collections of humans driven by greed, fear, and herd behavior. Third is the self-fulfilling prophecy. When millions of traders are watching the exact same price levels, their collective actions can make those levels matter, even if they had no intrinsic significance to begin with. This leads us to the central question. Does the market actually remember? If it does, past prices should help us predict the future. If it does not, every price movement is essentially a coin flip. Economists have debated this for decades, and the answer is rarely a simple yes or no. It depends heavily on the time frame, the specific asset, and the current market regime. The data shows us that while the market is not perfectly efficient, it is dangerously close to a random walk. In 1991, Andrew Lo, now at MIT Sloan, published a landmark paper in Econometrica. He developed a modified statistical method to test for long-term memory in stock prices across daily, weekly, monthly, and annual indexes. His findings were striking. He discovered no evidence of long-range dependence in United States stock returns once short-term autocorrelations were accounted for. Lowe concluded that the market does not remember beyond the very recent past, meaning simple short-range models are usually sufficient to capture how stocks behave. However, more recent studies tell a slightly different story. Researchers like Gil Alana analyzed 7 global indices, including the S&P 500 and the Dow Jones, between 2009 and 2020. They found that price shocks are highly persistent and nearly permanent. While there was slight evidence of mean reversion at lower frequencies, the convergence process is incredibly slow. In plain English, the market mostly forgets, but it does so gradually rather than instantly. Even if prices themselves don't seem to have a long memory, volatility tells a different story. A 1986 study by Poturba and Summers tested whether volatility shocks persist. They found that while volatility does not wander forever, the shocks decay quite slowly. 3 months after a spike in volatility, the level remains elevated by over 20% of the initial shock. This is why we see volatility clustering. Calm periods tend to follow calm periods, and turbulent periods follow turbulent ones. Markets may forget prices quickly, but they remember fear for weeks. Then we have the momentum paradox, which is perhaps the most robust anomaly in financial economics. It works by buying stocks that have gone up and selling those that have gone down. Yet, it is prone to catastrophic crashes. Researchers Daniel and Moskowitz identified the three worst crashes in history: August 1932, down 77.5%, January 2001, down 46.8%, and April 2009, down 45.8%. The lesson is that momentum works beautifully until it suddenly doesn't, which almost always happens right after a market bottom. The 2020 COVID-19 bear market gave us a new entry in the record books. Even though it was the shortest bear market in S&P 500 history, momentum crashed twice that year. In April 2020, as the market rebounded, the winner minus loser portfolio dropped 28.2%. Then, in November, it crashed again by 26.2%. Both of these months rank among the 15 worst monthly returns ever recorded for momentum strategies. This proves that these crashes are not just historical curiosities. They are a very real, live risk in modern markets. Let's talk about support and resistance. These levels have no basis in balance sheets or cash flows. They work strictly because of crowd psychology. If enough traders believe the S&P 500 will bounce at 4,000, they place buy orders there. That demand creates the bounce, which in turn validates the belief. It is a classic self-fulfilling prophecy. The catch, however, is that this only functions as long as the crowd maintains that belief. The moment that faith breaks, the level loses all its meaning. The head and shoulders pattern is arguably the most famous formation in technical analysis, but its reliability is declining. Recent data shows it now fails roughly 50% of the time on downward breakouts, up from 26% in the 90s. A 2025 study of over 5,000 observations found that even inverse head and shoulders patterns only succeed about 73% of the time with volume confirmation, and just 54% without it. The more widely known a pattern becomes, the more its edge tends to degrade over time. The 200-day moving average is perhaps the most closely watched indicator in United States equities. Sundial Capital Research studied 11 instances since 1946 where the S&P 500 stayed above this average for over 200 sessions, dipped below for a short time, and then reclaimed it. The results were surprising. 3 months later, the mean return was negative 2.9%. 6 months and 1 year later, it was still negative 1.1%. Reclaiming the 200-day after a long streak isn't the guaranteed bullish signal many assume it to be. We have two distinct worldviews here, the fundamental analyst and the chartist. The fundamental analyst reads 10K filings and builds models to find intrinsic value. The technical analyst studies volume and supply-demand dynamics to figure out what the crowd will do next. Both paths have created billionaires, and both have led to bankruptcies. The question is not which one is right, but rather when each one is useful. You need to know which tool to reach for based on the specific market environment you are navigating. Academic critiques, led by Eugene Fama in 1970, argue for market efficiency. His theory posits three forms of efficiency, with the weak form claiming that past prices cannot predict future prices. If that were entirely true, technical analysis would be useless. However, while empirical evidence supports weak form efficiency for most major equities, we consistently see anomalies like momentum and post-earnings drift. These suggest that while the market is highly efficient, it is not perfectly so, leaving small windows of opportunity for those who know where to look. This is where the behavioral counterattack comes in. Humans are not computers. Psychologists Daniel Kahneman and Amos Tversky proved that losses are about 2.5 times as painful as equivalent gains are pleasurable. This is why investors hold losers too long and sell winners too early. Burton Malkiel himself admits that factors like overconfidence, herd mentality, and loss aversion drive irrational behavior. If we were perfectly rational, technical analysis wouldn't exist, but because we are biological organisms wired for survival, we create predictable patterns of behavior. The most successful firms, like Renaissance Technologies and Citadel, have moved beyond drawing lines on charts. They use quantitative models that apply technical analysis at a massive automated scale. A 2025 study showed that state-dependent momentum strategies, which switch tactics depending on whether we are in a bull or bear market, achieved far superior risk-adjusted returns than traditional momentum. The future of technical analysis isn't about eyeballing charts. It is about systematic, rules-based, and back-tested strategies that remove human emotion from the equation. So, when does technical analysis work best? It shines in four specific conditions: in highly liquid markets with many participants, in strong trends where momentum persists, at intermediate timeframes where behavioral biases are most visible, and, most importantly, when it is paired with strict risk management. Without stop losses and proper position sizing, technical analysis isn't a strategy, it is just astrology. You must have the humility to admit when a pattern fails and the discipline to cut your losses before they become a disaster. Conversely, technical analysis fails under four conditions: in choppy, range-bound markets that create whipsaws, during major regime changes like Fed pivots or pandemics, during black swan events like the 2010 flash crash, and when a model is overfitted to past data. As the statistician George Box famously said, all models are wrong, but some are useful. If you try to force a pattern to explain every single movement in the market, you will likely find that your model has zero predictive power when the environment shifts. Every analyst must accept three hard limits. First, technical analysis has no causal mechanism. A head and shoulders pattern is a correlation, not a cause. Second, it is inherently lagging because it is built on past price data. It confirms what happened. It does not predict what will happen. Third, it cannot value anything. It tells you what the price is, but not if that price is cheap or expensive. For that, you absolutely must rely on the fundamental analysis we covered in Season 2. To synthesize this, think of technical analysis as a lens for understanding the herd. The market has a memory, but it is short, selective, and unreliable. The best practitioners combine statistical rigor with an understanding of human behavior. They recognize that patterns work because people believe in them, and they fail when that belief evaporates. Use technical analysis for timing and risk management, and use fundamental analysis to understand the intrinsic value of what you own. They are not enemies. They are different tools for different questions. In our next episode, we are going to strip away the indicators entirely and study pure price action. We will look at the raw language of the market through candlestick patterns and volume signatures. We will examine the doji, the hammer, and the engulfing pattern to see what they reveal about the ongoing battle between buyers and sellers. No indicators, no complexity, just the raw data of price and volume. I look forward to seeing you in episode 19.